All right, well, seeing no one in the waiting room, I say we kick things off. So hello and welcome everyone to our Winter Alumni College series and our next course, the Tax Law Changes under the Biden Administration. My name is Stephanie Maringer and I am the Assistant Director of Regional Programs. And joining me tonight is Brad Kors and Jordan McNichol. They are both major gift officers here at the College of Worcester. So if you need any assistance with Zoom tonight, you can reach out to any of the three of us and we will do our best to assist you. And you can just use the chat function to contact us. Also for the chat tonight, feel free to let us know where you're joining us from. Feel free to reach out to each other. And then also, if you have any questions or comments throughout tonight's course, go ahead and drop them in the chat. That way we see that you've got a question and we give a chance to, or we have a chance to call on you. Let's see. Oh, another thing, to fully participate in tonight's course and to make it feel as much like a Worcester classroom as possible, as much as we can in this virtual setting, we encourage you to turn on your video so that we can all see your smiling faces. And then we have done our best to make this course as accessible as possible by providing a live transcript, which I will provide the link and drop that in the chat. If you click on that link, it will open up a live transcript in a separate browser. So feel free to do that if you would like. We are recording this session, so try to minimize any sort of like movement in the background if you can avoid it. And I think that is it. So without further ado, I will turn it over to Bill Stromsem and thank him so much for leading this course tonight and sharing all of his knowledge with us. So take it away, Bill.
Hello, everybody. Let me see if I can share a screen here. I'm Bill Stromsem. I was class of '68 at Worcester. I'm now an assistant professor at George Washington University in the School of Business, where I teach various tax courses, graduate and undergraduate. I'm an attorney and CPA. I'm probably a failure though, because I'm still working a full-time job when everybody else is relaxing and retired. First, I hope you guys are all warm and safe. It's a tough time of the year. I welcome you, glad you could make it tonight. I recognize that I have three classmates. I see John Allen there. John was my freshman year roommate. And I haven't seen Dave Purcell yet, but Dave Purcell was my sophomore year roommate. Dave, are you there? I didn't see him in the gallery. Again, it's tough weather around the country. I just want to, and Jim Mayer is also a classmate of ours, and I saw he'd signed up for the course. I wanted to mention one item with respect to fundraising. Dave Purcell and I have stayed in really close contact over the years. And a few years ago, I was vacationing in Florida and Dave happened to be vacationing in Florida too. And he said, well, hey, why don't I come up and we'll spend a little time together. So sure enough, he came up, we went to the beach, we took walks, we did, all the things we should do. And we went out to a place called Willie's, which is like a beach bar. It's a tiki hut. It serves really great burgers, and we're sitting there having a burger and a beer, and Dave's cell phone rings. Dave picks it up and he says, oh, Bill, I think this is for you. He hands it over to me. And I said, hello. And the person on the other end of the line has, hi, I'm Sally. I'm a sophomore at the College of Worcester and I'm calling today. Dave passed this to me. If I'd been smart, I would have volunteered Dave for a major contribution. But in any case, I guess the thing I'd say is that the contacts you make at school are just really special, and I'm happy we can all get together tonight. This buckle up is what I'm titling this, because when Chuck Schumer learned that the Democrats had won both the House, well, they knew they had the House, but they won both Georgia runoff seats, and that meant that Chuck Schumer was going to be the majority leader in the Senate, replacing Mitch McConnell. And now he knew it would be Nancy Pelosi in the House, Chuck Schumer in the Senate, and Joe Biden in the administration. And they would have a pretty good opportunity to make some major changes. And some of them he had tipped off in the campaign. But I sort of like that. Buckle up, get ready for big change. You're gonna, and maybe a wild ride here as we go through legislation. There are some caveats. Joe Biden made promises that he wouldn't raise taxes on anyone earning under $400,000. And that may not be a shared number with everybody in Congress. 400,000 is a rich person's salary to a lot of people, particularly if you're looking at Elizabeth Warren, Bernie Sanders, and others who felt that we should, there's too much wealth concentrated in the hands of too few people, and it's we should try and do some wealth redistribution, maybe with some greater taxes. And we'll have to see. The Democrats in Congress will write the tax laws, and possibly Joe Biden will be able to lead them. But it may be, we'll just have to see how it shakes out. It may be that Congress will lead him. And if Joe Biden got a bill that said 300,000 instead of 400,000, would he veto it? Unlikely. Will he try and control it to keep his election promise? Yes, but again, he doesn't write the tax law, so we don't quite know where it's going to come. And we have a lot of revenue needs. We have all kinds of promises about student loans, $10,000 of student loans being forgiven, healthcare, infrastructure, all the stimulus to the economy and vaccinations and things like that, all very expensive. And revenues are down a little bit because we haven't had as much economic activity in the last year. So we'll just have to see where they're going to get the money, or if they're just going to keep printing the money and sending it out to people, at least in the short term. We'll have to wait and see that when you say no tax, we're going to raise taxes 2.6%, it's all on the wealthiest. Well, there's some details in there. We'll get into that in a minute. But I guess some of the interesting things here too are with that exact 50-50 split in the Senate, it's going to be difficult to pass anything that's unpopular with anybody. For instance, Joe Biden would like to enact some estate tax increases, but Democrats may not all go lockstep with that. If they have constituents with ranches or farms or small businesses that would be adversely affected, you have to keep all Democrats in line and hopefully attract some Republicans. Otherwise, you have some difficult times. Normally, you need 60 votes to close off debate, and that's the threshold for enacting anything in the Senate. Otherwise, you could have a filibuster. If you have budget reconciliation, you can pass with just 50-50, and then the vice president breaking the tie. But there are limits to that. First of all, it doesn't sound very collaborative or and any of the promises about bipartisanship, and I'm not sure how that's going to shake out. But the problem with trying to govern with that revenue reconciliation and the 51-50 tiebreaker vote is that revenue reconciliation is very limited in what it can do. In the Senate, the old rules, I think these were Harry Byrd's idea when he was Senate Majority Leader, but they're still in effect. You can only have three reconciliation bills in a year. One would be for revenue, one would be for expense, and the other for debt ceiling. Well, if we get the COVID relief bill through, and there is some bipartisan concern there as to the level of money that we're spending, whether it's targeted right. I think the idea that we'll have minimum wage in there is probably out the door. Even Joe Biden has sort of dropped that, even though it was his proposal. But if you have to use revenue reconciliation here, or reconciliation procedures, you've used up one of your 3 for the year, and the rest you have to do bipartisan, or you don't have a chance of getting things done unless they're really popular also with the Republicans. So what happens to healthcare, immigration, infrastructure, all these things are going to be very hard to do. Again, you only get 3 a year, and it looks like one's going to be used in the first 2 months of his presidency as we deal with COVID relief. The other issue is, although Joe Biden has talked about increasing taxes, particularly on high-income individuals and on, let me do one thing here. On high individuals and large corporations, it's those may not fly very well this year. It's very hard when you have a fragile economy to say, hey, let's raise taxes. And also, again, some of the other proposals, the estate and gift tax changes, you may not get all everybody has constituents it would be adversely affected by. And it's a small minority, very small minority pay estate taxes, but they're still an important, they're very often important constituents. Let's see. So moving on, having said all that, let me just go through some of Joe Biden's proposals, the things that he talked about in campaigning. And they have to understand that this is what he says in a campaign. He wants to say, yeah, I'm not a radical. I'm not going to really be a heavy-handed kind of restructuring the whole social order kind of president. I'm not going to hit anybody who earns under 400,000. Well, that's a nice political promise, and I'm sure he intends to keep that. But again, we need revenue to just keep things going. So anyway, the first thing Joe Biden wants to do, he wants to have higher taxes on the wealthy. Let me see there. Okay, so there's Scrooge McDuck, unhappy that someone's trying to get his money and it seems to be flying away. Here's what Joe Biden would do. He has said that he would increase the tax rate on those earning 400,000 or more from 37% to 39.6%. That is the rate that we had right before the Tax Cuts and Jobs Act in 2017 when the Republicans controlled the House, Senate, and the presidency. When this is enacted, and again, it's uncertain as to whether they'll be able to do that this year. There'll be some pressure from some of the wealth redistribution Democrats to get busy and start hitting some of those high income taxpayers. But again, there's some people who would also say, hey, let's not rock the boat while we're trying to recover from this economic slowdown, at least slowdown. And so it may not come this year. If it comes at some point, you won't have one tax rate leading up to the date of enactment and another tax rate for income after that. They'll put a blended rate into effect, so it will average where they want to end up, and then be 39.6% in the next tax year. Now, 2.6% increase in the tax rate doesn't sound like much, and we aren't too worried about Uncle Scrooge there. And but let's go through and get a little bit of the devil's in the detail, as I said. Social Security taxes. He would also start collecting Social Security taxes when earnings are over 400,000. So in addition to the 2.6%, he would add another 6.2% on earnings for those people. And if they're self-employed, that is, they pay both the employer and the employee part of Social Security, that's 12.4%. And that brings your marginal tax rate up to 52%. That would apply, a self-employed rate would apply to an attorney, a CPA, maybe a performing artist or an athlete. I'll just mention to you, I had a tennis playing athlete who, this was when I was in practice with Arthur Anderson, who was a top world tennis player I won't say his name, but he was from Sweden, if that's any hint. In Sweden, they have a very progressive tax and social system. They had very great social benefits, but their view in Sweden was that not only should you pay a very high income tax if you have income, like a top international tennis player, but there also ought to be a wealth tax that would take away some of the excess wealth that you've managed to accumulate. And the tax rate was so high that one of the advice things we did that he followed was he bought a condo in Monaco where there's no taxes and moved down there, moved away. If you get to, 50%, 52%, start getting up much higher than that and people start trying to either avoid tax or relocate. Today, with the virtual world, we can, you don't have to be in an expensive state. We've seen people migrating from higher tax rate states. You could have people migrate from a higher tax rate country. But again, we're a long way from that. But when you say it's only going up 2.6%, and that ends up in the end being 52%. Now there's some more coming too here. By the way, that increase in your Social Security tax payments normally there's like an annuity factor. To the extent that you've paid in, you get a higher benefit coming out. But that additional pay-in would not equate to additional benefits. It's targeted to make Social Security a little more viable and provide greater benefits to low-income individuals, greater Social Security benefits. Now, I got a planning point there at the bottom. If you're a closely held business, you could reduce your compensation and you get an increase in business income, but you wouldn't have to pay that 6.2 or 12.4% tax. That's just a nice little planning point there. Additionally, if you are in a partnership or an S corporation where you get what's called a qualified business income deduction, to the extent that you lower your cost, you raise your income and have a greater qualified business income deduction. That's 20% of your bottom line income. And we'll talk maybe a little bit about that later. Capital gains. Capital gains is another place where we could have some big increases. Today, we have a preferential rate on capital gains, and it ranges from 0% for low-income taxpayers. That's always a catch-22. Low-income taxpayers get 0% on all their sales of capital assets. Well, how many? I run a low-income taxpayer clinic, and I don't see a whole lot of buy-sell transactions in those low-income taxpayers. But if you're below 15% rate for your marginal tax rate, then you have a 0% rate. Most people have a 15% rate on long-term capital gains, and high-income people have a 20%. So the most you would have is the preferential rate of 20% on capital gains. Joe Biden has said for people with incomes over $1 million, he would eliminate the preferential rate. That would increase taxes on capital gains from 20% to the maximum individual rate, 39.6%. In addition, on both the 20 and the 39.6, there's also what's called an NII, net investment income tax, of 3.8%. So again, we're hitting capital there pretty well. It sounds like, hey, I don't, if they're making $1 million, what's a big deal? They should pay a little more. But if you're selling a farm, a business, or home, that would be capital gains potentially, and that might put you into that category. And there could be some exemptions. We'll have to see how the details plan out. The planning point here is if you have some highly appreciated assets, go ahead and sell before the date of enactment. We don't know when that will be. Typically, it's the date of first consideration by the Ways and Means Committee. So it likely wouldn't be retroactive. So you'll have a little bit of an opportunity, but again, for high income, and this is planning for high income individuals. I have something later for those of us who aren't in the over $1 million income level. All right, so one of the things that could happen here is that people have invested for capital gains. You get that preferential tax rate. And with that near doubling of the tax on capital gains, some high income taxpayers may shift income away from capital gain type. And when you invest, you invest for capital gains, income, security, and then there's another factor, enjoyment. That's like if you invest in art or a beach house or something. But the three classics are capital gains, income, and security. Well, as you end up with higher tax on capital gains, people may shift over to income. That would be interest income, because dividends is another area where Joe Biden would raise the taxes. So we'll have to see how the whole thing plays out. If there was concern that once Joe Biden was elected and this threat to capital gains enactment, people would sell, and take the market down. It certainly hasn't gone that direction so far. I mentioned that dividends are also taxed at preferential rates. They're the same preferential rates at the same income thresholds. And the idea of taxing dividends at your regular tax rate, that up to 39.6%, is basically to say that, hey, people who are sitting back collecting dividends should not be taxed at a lower rate than people who are working and sweating to earn their living. Again, this could mean that dividend stocks might not be as worthwhile as they were in the past. You always have to look at your after-tax yield on investments, and the after-tax yield on dividend stocks will go down if the tax rate goes up. So again, think about purchasing debt instruments. Interest income was still taxed at a high rate. You don't get the preferential rate on that to begin with, but the value of the security already has that after-tax effect built into the price. Itemized deductions. A couple of things going on here. Joe Biden would bring back what are called the P's limits on itemized deductions. Basically, this limits the value of itemized deductions for higher income people. And in the past, the way this worked was itemized deductions were reduced by 3% of every dollar of taxable income over a threshold. So 400,000 would be Biden's promise. I guess that would be where he would start the phase out. And then we'd have to figure out how we deal with married versus single. So there isn't a marriage penalty. The reduction is capped at 80%. So the total value of itemized deductions, you'll still get at least 20% of your deductions. So that's another place where we're going after Uncle Scrooge here, taking away his itemized deductions. Interestingly, there's, well, one of the nice parts of the Tax Cuts and Jobs Act was it increased the standard deduction and limited itemized deductions. This actually is fairly egalitarian in its effect. You're giving low-income people a greater deduction. You're taking away some deductions. Remember, state and local taxes were cut back. State and local taxes hit higher income people because they have higher income to be taxed by state income taxes, and higher value homes and things, wealth for the real estate tax deduction. So eliminating that, or limiting that to $10,000, really hit high income people, while the standard deduction went the other way, giving even fairly low income people a pretty generous, took a lot of people off the rules for filing. Now, if we're going to take away some of the, if we're going to restore some of the breaks to these higher income people, the question, I guess, would be, would we reduce the standard deduction? And I don't think so. It's not very likely. There's only one area here that's a little going to be interesting to follow. When they were dealing with COVID relief legislation, Chuck Schumer from New York and Nancy Pelosi from California, both where you have high real estate value and high state tax rates, income tax rates, both of them were holding out for a provision in the COVID relief bill that would restore the full deductibility of state and local taxes. These were limited in the Tax Cuts and Jobs Act to $10,000. Now, it's interesting because this is a benefit that you have the Democratic leadership supposedly looking out for the small guy, looking out for Uncle Scrooge a little bit. If you live in an area like New York or California or here in Washington, when they limited that to $10,000, that includes real estate taxes and income taxes. A lot of people lost, tens of thousands of deductions there. And if this comes back, it'll be a nice benefit. The interesting thing there too, though, is that when you got rid of the state and local tax deduction and cut back on some of the other deductions, a lot more even moderate or even higher income people use the standard deduction. You've got about a $24,000, $25,000 standard deduction. If you think about your real estate taxes and income taxes limited to $10,000, you have charitable contributions, I guess. Most higher income people don't have medical expense deductions. They've got good insurance, and you don't reach the threshold, 7% of AGI unreimbursed expenses limit. Interest deductions are limited a little bit, and the older, wealthier people may have their mortgage paid off, so they didn't have that deduction. I'm surprised at how many people I think that I do tax returns for who are high income, who took a standard deduction for the first time. We've always looked at the standard deduction as kind of a poor man's itemized deduction. They don't have enough in expenses to itemize, so they take the standard deduction. But now it's going to change, and you may see fewer people, though, if Joe Biden if the Democrats move the state and local tax deduction. That can be $40,000 or $50,000 very easily. If you think of someone earning $500,000 a year times 8% in Washington, that's 40,000, and then your real estate taxes on a $1 million home would be another 30,000. That's 70,000. Was limited to $10,000 maximum, and now these people may be using the standard deduction once again. Estate and gift taxes. Currently, nobody pays estate and gift taxes practically. You have to be super wealthy because in the Tax Cuts and Jobs Act of 2017, they increased the amount of bequests at death or lifetime gifts that you could give tax-free to $11,700 per person, meaning that a married couple who consent to splitting gifts could pass down $23,400, $23,400,000, slipped at 3 zeros there. Joe Biden would drop that to 3.5 million per taxpayer. Still a pretty good number, but the problem with estate and gift taxes is that after you get through that 3.5 million exemption, basically, the rates go very quickly up to 40%. Joe Biden would raise that rate to 45%. So you would reach those high tax rates on your net worth at a lower level. So again, one of the other problems he has is he would limit the amount of lifetime gifts you could give to, I think it was $1 million. Yeah, lifetime gift to $1 million. And with that limit, you're going to end up with limited ability to transfer assets to avoid this. Currently, you could go ahead and give, if you have it, you could go ahead and give them 10, 11, 12, 20, 23, 4, whatever you and your wife can afford. You can give it to the kids or whatever, tax-free. So if this looks like it's developing, those with large amounts of assets might want to take advantage of the ability to make those transfers by gift tax-free before they start to get very taxable. Okay, another proposal of Joe Biden is what's called stepped up basis at death. If I purchased stock 15 years ago and it was 300,000 and today it's $1 million, if I sell that, I'm going to have to pay tax on 700,000. If I gift that to my children will have to pay tax on appreciation of 700,000 because they take my basis, my $300,000 basis, and if they sell it for $1 million, they would have to pay tax on 700,000. The loophole is that you can, if you die holding that, your heirs take it at fair market with a basis of fair market value of date of death, and you don't pay any tax on the appreciation. That's called step up at death, stepped up basis at death. And basically what it means is that that 700,000 in appreciation doesn't get taxed today. It's perceived as a loophole, and they've tried several times to close this down. One of the problems you have right now is that older people may have some assets that they acquired years ago that have become highly appreciated, and they can't really afford to, they don't want to sell it and pay tax, and they don't want to give it to their kids and make them have to pay tax. So the strategy is to just wait until you die. It's, again, a tough loophole to get through, but hey, I actually had, when I was a junior accountant at Arthur Andersen, I was working with one of the wealthiest families in DC on their estate planning. I was working with the big man, I won't mention the name, his assistant. And one day he called me on the phone and said, Bill, Mr. So-and-so is thinking of selling 1 million shares of stock. Well, 1 million shares of stock at that point, that would have been a sale of roughly $60 million. And since this was a self-created business, he would have had to pay tax on $60 million of gain. And I had to, as delicately as I could, say, hey, Mr. Big is very old. He's got one foot in the grave and the other on the banana peel. Why didn't he just keel over and save us all those taxes? You have to say that a little more delicately, but that's the idea. People end up locked into these assets, and sometimes older people have the wrong assets. They want income and security, and they may be in, the 3 investment objectives. They want income and security, and they may not worry too much about capital appreciation. They'd rather trade that capital appreciation for income security, but they can't do that because they'd have to pay tax if they sold the appreciation stock. So they're what's called locked in to those assets. President Biden has said he would eliminate this loophole, and there's 2 ways to do that. You can either have death be a realization event, so that capital gains apply on the last return of the decedent. When they die, it's deemed to be a sale and collect capital gains tax on the appreciation at that point. The other alternative is carryover basis, where like the gift, we take that, the children take the parents' basis in the asset, and then they have to pay tax when they sell it. Both of those have problems. Carryover basis, they've tried this before. It was repealed retroactively ab initio, as if it had never been enacted. And the problem there is that carryover basis, you have trouble telling what a decedent's basis was because the decedent is no longer there to answer your questions. How much did you put into this? Did you get it by gift, or did you get it by bequest, or did you get it in exchange? Did you sell some? Did you buy? It's hard to come up with that. And so carryover basis was almost unworkable. And the other one, capital gains at death, can cause real liquidity problems for an estate. You have to pay tax on appreciation, something that may not have been planned for. This may cause a sale of a family farm, the home, the business. There's some relief in the tax law for high estate taxes that way, but capital gains at death, there'd have to be some relief. And again, this may cause some of these, I mentioned down here, would cause some complex rules. So the planning point here, before you get rid of this step up in basis at death, you want to take grandpa on a roller coaster tour of the US, or take them out for a picnic where you serve some warm potatoes or egg salad sandwiches. Seriously, you don't want that tax tail to wag the dog, but there is a big price here once this gets enacted. So the better planning is to give those assets away while you still have time. Another one is you want to document your basis so that if this gets enacted, because otherwise your heirs will be sitting around scratching their heads. They won't be able to figure out, what the correct basis is to measure the gain from. One of the nice parts about this is that it would get rid of that lock-in problem for older people. They would no longer be unable to sell it because they're going to have to pay the tax on it one way or the other. They couldn't avoid it by going on that roller coaster tour. Wealth taxes. Wealth taxes are something that were embraced by Elizabeth Warren, Bernie Sanders. Basically, this is just a small percentage, 1 or 2%, although everybody worries that, it's a camel's nose under the tent, that, you start at 1 or 2% and it starts generating a lot of revenue, and you want to go ahead and get a little more revenue, and then you raise it to 3 or 4%. Who cares? It's wealthy people. Maybe that's true. Maybe wealthy people should pay more. But there is a potential for a triple tax with this proposal. You would have income tax when you earn it. When you accumulate enough wealth, you would have that wealth tax. And then when you transfer it by gift or bequest, you would have an estate and gift tax. Now, President Biden has not proposed a wealth tax, but Bernie Sanders got a lot of traction with this argument. He talked about how much wealth was concentrated in the hands of a few, and this was a very populist thing that really resonated with people, and it resonates with a lot of people in Congress. And again, to the extent that Joe Biden leads, maybe he can avoid this. To the extent that he's led by Congress, it may be something that will be hard to resist. And again, I note down there that Bernie Sanders and Elizabeth Warren are still in the Senate. And the way to avoid those wealth taxes is the planning point there is move to Bermuda or Monaco, both very nice places. Trouble is be able to get into those countries. A lot of people have the same idea. It's hard to, if you want to move to Bermuda, tomorrow you have to have applied for citizenship there 20 years ago. Okay, there's our friend. He's been everywhere, right? Everybody loves Bernie, don't you? I mean, just seeing him there makes me want to go for a wealth tax. That's good old Bernie. Okay, so I said middle class, middle income families. You need tax breaks for middle income families. Now look at this, doesn't that, we all can remember when we had this kind of stuff and this kind of stuff. The dogs in the bed. What a nightmare. Oh, I guess is that a cat down here? I don't know. Anyway, we need to come up with some, I apologize, middle class. That sounds terrible. I meant middle income families. Anyway, this is a group that is kind of stuck in the middle. You have to get a little more revenue than you can squeeze out of the wealthy. You can't squeeze any more out of the lower income people. So they tend to come up with, they tend to bear maybe at least a lot of middle income people think their taxes are too high. Everybody thinks their taxes are too high, but middle income people may have a real claim to it because of the needs. They're raising a family, whatever. So here are some of Joe Biden's recommendations here. He would increase what's called the child tax credit. And basically the child tax credit, and you've seen this in the news lately, this is a credit that's refundable, and it phases out at higher income levels because they assume that higher income people can pay for their own damn kids, but lower income people need a little help. So currently we have a $2,000 child tax credit that will go to $3,000 for people age 6 to 17 and to $3,600 for people under age 6. Again, we need some money to do that. Another interesting break for low-income families where you have 2 working spouses is the child and dependent care credit. Child and dependent care credit, basically, if both spouses are working and they need to employ someone to care for a child or an elderly member of the family or something, there was a credit available to reduce your taxes. A credit reduces your taxes dollar for dollar, just for reference. And the proposed credit, the current credit, the maximum is $1,200 big dollars. Now, if any of you have kids or have kids who have kids, as I have, you know that $1,200 doesn't do a whole lot toward paying for a babysitter for the year. And that's that 1,200 credit. You have to have 2 or more kids that the babysitter's watching. Well, I can just tell you from one of my kids in New York that someone watching your kids is more like $30,000-$40,000 a year than $1,200. Joe Biden would raise that to $8,000 per dependent, up to 2 children, for a maximum credit of $16,000. So you can get $16,000 for 2. After that, you don't want to have more kids because you're going to have to pay the babysitter more, and you're not going to get any more child and dependent care credit. Although you will get more in the way of a child tax credit. So here, the objective is to have the exact right number of children. You want to get a spreadsheet, decide how many kids you should have. You don't want to have too many. You won't get any additional benefits. You don't want to have too few because you want to get enough benefits. So that spreadsheet would really serve you well in tax planning. Either that or you can just go for it. Okay, student debt. When I talk to my students on campus, there is a tremendous student debt problem here. Let me flip to my next slide and we'll come back. Look at this, all my students coming out of graduating and going off into the house of debt. Anyway, what Joe Biden would do would be he would forgive up to $10,000 in student loan debt. And currently, if you have a forgiveness of student loan debt, it's included in income. If someone forgives your debt, it's as if they gave you money to pay off the debt currently. So you have to, it's not a gift, it's income to you and you have to pay tax on it. So if you're forgiven a $10,000 student loan, you end up having to pay a couple $1,000s in federal and state taxes on it. Currently, the debt forgiveness is over, if you make faithful payments for 20 to 25 years, you have to give them 10% of your disposable income toward your debt. And if you do that for 20 or 25 years, they'll forgive some of your student debt. Now, the Biden proposal would change that from 10% of all your disposable income has to go to 5%. Biden people would also say that it would not result in forgiveness of indebtedness income. These are very expensive proposals. If you think about how many people go to college, or how many more would go to college if they can afford it, it's very, very expensive. And trying to pick up this debt for people, while it's a great, it brings a lot of younger voters to support these proposals and a lot of families with high debt. But I'm not sure how helpful it really is. I can just tell you at GW where I work, and maybe Stephanie or somebody could chime in and say what the tuition is at Worcester. GW has very high tuition. You have tuition alone is $56,153, and you have to add to that another $16,300 for your on-campus room and board. So you're looking there at $72,500 to go to school there. Now, $10,000 in debt. I mean, I have students who are graduating with a couple $100,000 in debt. Maybe not a couple $100,000, $100,000 easily. So I'm not sure 10,000 is going to solve the problem for those individuals. It would be helpful to people maybe who are lower income and are going to community college or something like that. But I'm guessing, Stephanie, do you by any chance know what the Worcester tuition is these days?
I just looked it up. So the College of Worcester, the comprehensive fee, so that includes tuition and fees, room and board for the upcoming 2021-2022 school year will be $68,600.
So, it's very expensive to go to school. At one point, it was said by Barack Obama and Joe Biden that everybody should be able to go to school. It may be the right answer. We need an educated populace, an educated workforce. But at current tuition rates, it's just so expensive. It's hard to imagine. Nobody's been able to come up with a solution yet. We've had all kinds of provisions over the years to try and give some benefit toward tuition. You have the various proposals. They've always been sort of band-aids on a gushing artery of tuition increases. The planning point here, and this is probably more for my students and for you, would be to keep making the payments. If you're in a forgiveness program, you have to keep making those payments or you'll get dropped out of the forgiveness of indebtedness program. But otherwise, you want to wait and see how much will be forgiven and hope to be able to take advantage of it. Again, hopefully it'll be meaningful, but I think for schools, for the more premier schools, what this could do would be to build a difference between the low-income people who can't afford the debt and end up at the community college, and we already have some of that. But I'll get off my preaching chair here. Okay, so affordable housing. We've had at different times to stimulate the housing market and to provide affordable housing for people. We've had a first-time home buyers credit. It started, maybe 10 years ago. There was an $8,000 first-time home buyers credit. It's up. Joe Biden would raise this to $15,000, increase it. He would also recognize that not everybody, and that's sort of the population is changing its views. You end up with a lot of people who say, hey, why should I be tied down to a house? All the maintenance, all the worry. It's not anymore to rent a house. I can move quickly if I get a job somewhere else, et cetera, et cetera. More people are renting. And to take that into consideration, Joe Biden would provide a renter's credit. And that would fill the gap for low-income individuals so that they wouldn't have to pay more than 30% of their income for housing. If you have kids or grandkids, or if you're in the market, hold off purchase until you see what this first-time home buyers credit turns out to be. Hopefully, $15,000 discount on a brand new first house is not a bad deal. Okay, this is a Monopoly house. Somebody actually has a house that was constructed to look like a Monopoly house. So I thought that was, I like that picture. Affordable housing, I don't know. All right, for seniors, there's a few proposals here. You could take money out of your retirement savings to pay for long-term care. There'd be a $5,000 credit for family members and others who provide long-term care for the elderly. So if I move my parents, this may be a high price to pay for that, a little compensation for the high price of having me move in with my kids, but I guess they could get a $5,000 credit as sort of a consolation prize. I'll be sure to tell them about that. Fortunately, at this point, I'm not quite ready to need long-term care in home for my kids. Yep, that's not where I want to be. I do have a place in Florida though, and I have, and it really is, I can't believe that I was in a mall and there was a major area of the mall where they had set out rocking chairs, and there were a lot of seniors rocking in the rocking chairs. Anyway, they're important. I'm in that category. Not quite here yet, but I do exercise. Right, low-income taxpayers. I told you it wasn't all about taking care of the rich. It's mostly about taking care of the rich. I'm sorry, my orientation and those of students who are studying accounting is to worry about sort of clients and higher income taxpayers. But I also run, as I said, a low income taxpayer clinic at GW and have a lot of students that volunteer to help people. Actually, this earned income credit is for working families. And it varies depending on the size of your family and your level of income. And it can go up to about $6,000. And it's refundable. Basically, when they reformed the government back around at the end of the millennium, they said, hey, we're collecting information about income, family members and stuff like that for welfare checks. And I'm sorry for the term, that's what it was. We had a Department of Health, Education, and Welfare. And they would cut checks to people based on the size of their families and the level of income and what their needs were. And they also were collecting that same information in the on the tax forms. So to streamline government and just ask these same questions once, they said, why don't we structure this through the tax law? We'll refund people money that they didn't pay. They didn't have withholding, they didn't have estimated payments. It's like a negative tax for low-income working families. And interestingly, in my low-income taxpayer clinic one day, I was looking at returns that had come in, and in the last hour, 4 returns had come in, and 4 families, a total of 14 people, had income less than the tuition of my students, less than that $72,000 or whatever. And it really was a great experience for these students, a great pro bono experience to see how they could help these people get this benefit. Unfortunately, the earned income credit is there's some of the most complex forms in the individual package. They're highly audited. Commercial return preparers charge quite a fee to prepare a return with an low income tax, an earned income tax credit. And so we organize CPAs and we train students and provide computers and everything and prepare returns for low income families. And I think it gives our students a little bit of a pro bono activity. I don't know if you have anything like that at Worcester. Does anybody know? It's VITA is the terminology, volunteer income tax assistance. All right. Well, they would now make the earned income credit available to seniors who are working and are over 65. Currently, if you were working, even if you were working for very little, you couldn't qualify for the earned income credit. And I mentioned VITA Clinic that I'm running. They would expand the funding for providing free tax return services to low-income families. Disabled individuals, there's a few provisions there. Small businesses that hire disabled individuals would get a small amount per hire. It scales down after the first year, after you've found out how valuable they can be. My experience in this, and they've had different credits for hiring difficult to hire people. Former people who have been imprisoned and are now out and are trying to get a start. They're hard to hire, and so they gave a credit for hiring former convicts. Unfortunately, I think what happened was that these companies would hire what they needed, and they really didn't. It was more of a windfall. They didn't go out and say, "Hey, let me know if you have any convicts that are looking for a job." Former convicts, I don't know. I'm probably using politically incorrect terminology there. I apologize. But it's the same with disabled individuals. I don't think companies are going to jump to hire disabled individuals. They may well hire disabled individuals for very good reasons, and the $5,000 is just a little bit of a windfall rather than an incentive in a lot of cases. Companies that are working to make their buildings more handicapped accessible could get a credit of up to $30,000. We've had handicapped accessible credits for years, but this would be an increase. If you are a business owner, you want to watch for that credit. If you're doing a renovation, you want to plan it after this gets enacted so you can take advantage of it. Energy tax breaks. I think I do some work with the Texas Society of CPAs, and I've written articles and major articles on energy tax relief provisions for the Texas Society of CPAs. And right now, Joe Biden is not, although Texas is moving toward more green energy, but and less dependence on oil. But there are a lot of people who are pretty disappointed at the pipeline cancellation and the threat to have greater taxes on energy activity. But again, and I don't want to make a political statement here, but right now, global warming, it doesn't seem so much of a threat, at least today in Maryland. But it is worth promoting, and we will see more credits for solar panels, battery packs, electric cars, things like that. So if you're considering an energy saving purchase, just you might want to wait a little bit and see what comes through in the way of a tax break. Electric car credits seem to be phasing out. I think we'll see those coming back, and solar panels, things like that. I think you're going to see a lot more of that. Wind, everything is going to be maybe supported to a greater extent. I think we'll have to see a little bit. Joe Biden has said that some of the fossil fuel energy jobs these people will be converted to becoming higher tech, higher paid people in the green energy field. But from having been down in Texas and worked on energy stuff, I'm not quite sure where some of the roughnecks will fit in. But anyway, progress has to come. We have to take care of the environment. We only have one place to live. All right, higher taxes on pass-through entities. Pass-through entities are partnerships, sole proprietorships, S corporations. You have corporations that pay tax at a corporate level, and then when they pay a dividend to the shareholder, the shareholder pays tax at the individual level. So there's two levels of tax there. For pass-through entities, that's those sole proprietorships, partnerships, S corporations, there's only one level of tax. The income is taxed as it passes through to the individual. And in 2017, when they lowered the corporate tax rate, they said, okay, how can we give a benefit to pass-through entities? Because they're taxed at the individual tax rate. And if we lower the tax rate on individuals, it wouldn't just go to businesses that were set up as pass-throughs, it would go to everybody. And so they came up with an idea for what's called a qualified business income deduction. Qualified business income deduction gives you 20% of your bottom line is a credit you can take against your, deduction that you can take against your income. So if you make $100,000, you only have to pay tax on 80,000 of that. And that basically, the Biden people would phase that out at higher income levels of the owners. And that, again, that might be good. But this gives a bigger description of how this works. 20% qualified business income deduction. Then you only have one rate of tax on that. That would be at the owner's highest level. If you take 39.6 and you take 20% of the income away from that, you get down to more of a 29.6% rate, whereas the corporate rate was reduced to 21%, but you then had to pay tax on the dividends. Again, he would phase this out. President Biden would phase it out for people earning over 400,000. And again, that could subject you to those higher rates, 39.6. All right, another thing he's proposing is taxes on big corporations, higher taxes on big corporations. Look at the little guys down here moving the ball along with a wedge, and the big guys like holding it in place. I don't mean to make light of this. I don't see, but this again, I must have been thinking Monopoly with those hats and things. Okay, rate increases. The Tax Cuts and Jobs Act lowered the tax rates from a 35% progressive rate, meaning that some income was taxed at lower rates, but if you had high enough income, you paid 35% on it. It changed it to a 21% flat rate. And the purpose of this was to make US corporations more competitive in the world market, to keep jobs and capital at home. And President Biden would increase this to a flat 28%, meaning that the very first dollar of corporate taxable income would be taxed at 28% instead of 21%. So again, the idea here of raising business taxes in a tough economic times may not fly that well. He's got some other provisions intended to keep jobs in the country. If you send jobs overseas, you would lose some of your benefits even retroactively. There'd be a tax on a surtax on US taxes if you sent jobs and manufacturing overseas, and other restrictions on overseas operations. Foreign operations, we had a major change in this in 2017. It actually, I think people are just now adjusting to it, and it seems to be working pretty well. But we've heard rumblings that the Biden people would like to crack down on pharmaceutical companies with overseas production, and others, again, trying to keep jobs in the US and income in the US. If you set up a new job in the US, create some jobs in the US, put in new facilities, there'd be some credits for people for reopening closed factories, for new manufacturing factories built. Again, if you're in a business, you may want to think about holding off until you see what's coming. All right, need for revenue. We have at this point, if you look at it, we have a pandemic we're trying to pay for. We're trying to stimulate the economy. Joe Biden has promised ambitious public benefit programs, healthcare, education, infrastructure, and we have to deal with a rapidly increasing national debt. You understand the power of compounding. Well, fortunately, our rates have been low, but who knows what will happen if we keep printing money. People may say, hey, you're just, your money's going to become worth less. We don't want to invest in your debt without a higher rate. So if you look at it, we had a year ago, a half year ago in 2020, we had a debt of $26.9 trillion, and that was up 4.2 trillion from the prior year. By the way, this is more than a trillion is more than we spent on World War II. You can go right through and come up with a lot of things that we've done with $1 trillion. $1 trillion is an amazing amount of money. It's the value of all the goods and services in the US for that last year was 21.5 trillion. So if we didn't consume anything, if we just took everything that we made and applied the money to serve the national debt, we'd still come up short. We're more than a year's worth of income in debt. And at some point, this can become overwhelming for the economy, particularly if interest rates start to rise. So how much is $1 trillion? I say $1 trillion and say, oh yeah, $1 trillion. Trillion here, trillion there. So eventually it adds up to some real money. So let me give you just an image here. If you put 7 $10 bills flat down on the pavement, side by side, just next to each other, and then you put 7 more dollars on top of those, and you kept stacking on those 7 piles, and you stacked more and more dollars, to the national debt, to pay that, you would have to stack those 7 stacks until they reached the moon. Now think of that. If you remember the Apollo missions, they're flying at high speed for a long time. And think next time you look up at the moon, think about those piles of money all the way to the moon. 7 piles of $1 bills go all the way to the moon to get to $1 trillion, to get to our national debt. Okay, so here's some questions I'll just pose to everybody, and we can, I'll stop lecturing here. We can start discussing. I guess you can pick any of these that you want to get into, or I'll just kind of stop here and let you guys weigh in if you want to. Anybody has any comments, questions, observations, whatever. I've facilitated this, but it's your class as well as mine. Stephanie, have you unmuted? Can you unmute people or let the, oh, I have a hand raised. Dave Purcell, I see my old sophomore year roomie there.
Okay, Dave, you should be able to unmute yourself here, and then we'll go to John next, who I know has a question.
Good job, Willie. I don't remember you being so smart. I remember during the Reagan administration, they were talking about trickle-down economics, which was the theory that if you got more money into the hands of the rich, they would somehow, by some means, that would be distributed downstream to us middle class, if you will, and poor folks. I don't think that has worked. I don't know that it's been exhaustively studied, but I get the sense that it hasn't worked at all. And I wonder if any real study has been done to try to reverse that, or to validate or invalidate it, and look at the possibility that something like putting more money in the hands of poor folks, for instance, the $1,400 payments, will wind up benefiting everybody because they spend that money and thus enrich the corporations, for instance, which are largely owned by the rich folks.
Well, you remember at the time that proposal was advanced by an economist named Arthur Laffer, and he put together a Laffer curve, which meant that as you had money coming in, if you reduce taxes on high income people, eventually, and corporations, the economy would grow and you'd actually bring in more money into the federal government. That Laffer curve, a lot of people referred to that as the guffaw curve. But in any case, I think you don't have to worry about trickle-down economics for the next 2 years at least. It looks like it's going to be trickle up. I will see how that works for a change. Anybody else? Sure.
All right, John, I know you've got a question, so you should be able to unmute yourself there.
Hello, everybody. Hi, Bill. So my first profession was just that, professional tennis. You hit on that earlier, but I certainly didn't. I'm not from Sweden. I didn't move to Monaco, but I'm also self-employed presently as a realtor. And so that was also covered early on. So, but here's my question. I have a long-term capital gain that's just been out there for a couple of decades. You know, with capital gain taxes potentially going up, I'm kind of wondering if I should look at really taking the gain now versus looking at it maybe potentially doubling on us. And I go back and forth about it. I haven't been chipping away at it as sometimes that's recommended, but I wonder what your thoughts are about it.
Well, people often say, don't let the tax tail wag the investment dog. You don't want to sell a good investment because of tax reasons. On the other hand, that doubling of the tax rate on it is significant. I think you have to look at it and selectively make choices. I guess also you're going to have to keep a weather eye toward Washington to see what's coming. I think there's I think there's a lot less sympathy in this administration for people with big capital gains like you.
Right.
I just put a note in the chat, but just so everyone knows, if you have questions or comments, you can feel free to share that in the chat, or you can also raise your hand on your video or virtually raise your hand on Zoom, and we will make sure to call on you.
Hey, here's some items that you might want to think about. What do you think? Is Joe Biden going to be able to give those social programs to everybody, very expensive, and only finance it with tax increases on the rich and large corporations? If you look at it, while Joe Biden, we had Bernie Sanders talking about the concentration of wealth in the hands of a few. If you look at it honestly, most taxes are paid by a very few. We have maybe 40% of the country that pays no taxes, net. Some of them, maybe 10%, get more back from the government than they pay in. You can look it up, fact check me on this, but it's more like 90% of the taxes are paid by the top 10% of income earners or something like that. Can you tax those people more without them all moving to Monaco, or just saying, hey, geez, why should I take risk? Why should I, if I'm going to make money, they're going to just take it all from me. I may as well just take it easy. I mean, what's the viability of this plan to not to lower income tax rates or keep them or give better tax cuts to people and try and take it all from the rich and the large corporations? Can they handle it? I guess that's one issue. Another one would be at what point do corporations move overseas, or individuals even move overseas? We've seen that for states. California and New York have a net loss in population, particularly New York, Manhattan. As people are relocating, they can work remotely. Can we ever pay down that 7 stacks of dollar bills going to the moon? Or is that just, or are we just going to keep printing money? If you can't use fiscal policy to tax, to raise more or to spend less, nobody wants to spend less, particularly during a pandemic or an economic slowdown. We need to spend more. But we don't want to tax more either, because that'll hurt the economy. So basically right now we're just printing money. We're printing money and paying people's salaries for corporations that can't afford it. At some point, are we going to end up with the dollar becoming worth less? And although we have the same amounts of dollars are worth less, that's kind of like a tax, monetary tax. And again, if we have a big debt, and we do you keep lending money to someone who just spends way beyond their means consistently? Or do you say, hey, if you want me to lend you some more money after all this binge you've been on, I'm going to have to charge you more because I'm not sure you'll ever get it back. Anyway, I'll just throw those out as sort of questions if anybody wants to comment, weigh in, whatever.
All right, Rich, you should be able to unmute yourself. There you go.
Thanks, Stephanie. Thanks, Bill. This has really been a very helpful and informative talk. About the debt, can you weigh in a little bit more? My thinking has always been, as we keep ratcheting up debt, hearing from so many, everything's going to crash because our debt keeps going up and up and up. As long as the US dollar is the world currency, and so far it is, the euro hasn't done a great job. The renminbi seems to not be taking over in that role. As long as the US dollar is the world currency, can't we kind of just keep printing money?
I think you can for a while. I would note that Bitcoin for the first time got, what was it, over $40,000 today?
Yeah, it hit almost 50 today.
It hit 50, and
Almost. Yeah.
Oil has started back up. Commodities are going up. I don't know, right now, you can't tell how much is supply chain, but I find that it's costing me more when I go to the grocery store, the gas station. We could have some inflation coming. But yeah, so far we've been able to trade off of our good reputation. We've never defaulted on anything. But if history is a major, and Dave and I were both history majors, I've probably got some other history majors here. If history is an indication, countries have done one of two things when they get into big debt. And we aren't to that point yet, but they either print money and pay it off with devalued currency, or they disavow the debt. They basically, and I don't know that we're going to disavow the debt. So I'm looking at the risk that we'll use monetary policy to get rid of the debt and we'll all end up with cheaper dollars. Those of us that don't have indexed retirement plans, which are now rare. I don't know, we're in a risky time here. And again, I'd say keep a weather eye on things. I understand that we've been able to get away with it so far, but that's sort of like the guy that jumps off the building and he was heard to say as he was passing the 75th floor, so far so good.
Far so good, that's right. Well, thank you.
Sure, and I don't know I have no crystal ball here. Anybody else, feel free to weigh in. I'm not a tremendous expert on fiscal monetary policy.
All right, next up is Frank. You should be unmuted now. Go ahead.
So I actually have another question on fiscal policy. In order to pay down the debt, you'd have to balance the budget and balance it pretty significantly for a long time. The last time the budget was balanced for any length of time was in the Clinton administration. Do you or anybody on the phone, on the call, know how the Clinton administration managed to balance the budget?
I see Bill's mouth is moving, but he's muted.
You should be able to unmute, Bill.
Okay, thanks. Well, I think the solution for Clinton was that he had a Republican Congress, and they wouldn't pass any of his initiatives to spend money. So he was forced to reduce the relative level of expenditure, and that resulted in the balanced budget. And but in terms of prospects, I can't foresee any circumstances in which we're going to have a balanced budget. The most you could possibly hope for would be that the debt would start rising more slowly than GDP. But even that is an awful long stretch from where we are right now.
You know, again, on
Can I ask a
inflation.
question while we're at it, if I could, and that's that there's been a lot of discussion, particularly in the European countries, about the taxation of whether it's Facebook or Amazon or Apple or some of the other multinationals. And do you see any possibility for joint action to focus more on worldwide income for many of these multinational companies?
Well, you're out of my field. We're going to have to get it somewhere. I mean, there's just one of the interesting things on the inflation front is if anybody can explain to me why the stock market is going through the roof when we have high unemployment, we have divided and combative fragmentation of our government, we have all this national debt growing, we have people unemployed, all these things that are going on. The only thing I can think is that people are looking at, hey, I've got to put my money somewhere that rather than in dollars, and they're putting it into stocks. And again, that's an inflationary indication that people are buying things instead of holding dollars. Anyway, I don't know how we deal with it. I don't see an easy path. I think we're going to be spending more than we earn for quite a while here. Certainly not in the next 2 to 4 years where we see anything like a balanced budget.
All right, Dave, go ahead. Should be able to unmute yourself.
Bill, please go back to the budget reconciliation limitations on, you mentioned that the COVID relief bill, 1.9 trillion or 600 billion or whatever it's going to be, would be the expense one. So these others would have to either be under revenue or debt ceiling if anything's to be done this year. Is that correct?
You can't have for instance, you can't have like a healthcare bill or an infrastructure bill unless you can get bipartisan support. I'm not saying you can't do anything. I'm saying you can't govern with a 50-50 split unless you're willing to try and be a little more bipartisan than we're seeing currently in government. I see the government is really a mess right now.
So if it was a soak the rich tax bill, I understand that would come under revenue. Would a relief to the poor folks be under the revenue?
You could put it together. Anything tax related, you could put into a reconciliation bill and run through. But again, you get one a year in each of those categories, and I think there are a whole lot more initiatives that Joe Biden would like to get done, and he's going to have some bipartisanship, which I don't see materializing.
Any other comments or questions before we wrap up?
Thank you all
All right.
for being a very attentive audience. I've enjoyed doing the presentation.
Oh, sorry. Thank you all so much for joining us. This has been great. And I hope that you had a lovely evening. Thanks for joining us. And keep an eye on your email for updates coming from the college and more information about how you can stay involved with us, particularly during this challenging year. So thanks so much, everyone. I hope you have a good rest of your night.